Hi, this is Buff Dormeier, KingsView's Chief Technical Analyst with this week's volume analysis flash update. As the market closed the final chapter of 2025 and opened the first page of 2026, conditions softened with a broadening tone that favored relative defense over leadership. The S&P 500, represented by the SPDR S&P 500 ETF Trust, declined roughly 1% on the week. Leadership retreated more sharply, with the Invesco QQQs, our generals, pulling back 1.7%. The troops, represented by the iShares Russell 2000 ETF, follow closely behind, falling down 1.57%. In contrast, the broader formation showed relative resilience. The S&P 500 Equal Weight ETF declined a more modest 0.48%, while the dividend-oriented brass commanders, represented by the Schwab U.S. Dividend Equity ETF, managed a small gain of approximately 0.3%. This dispersion suggests that investors favored balanced and income as the calendar turned, rather than concentrated leadership exposure. Volume conditions were notably subdued, even by short week standards. Upside volume and capital flows were particularly light. Capital-weighted downside volume registered near average levels. The weakness occurred primarily within the year's strongest performing units, consistent with late-year profit-taking rather than broad-based liquidation. Overall, 68% of the total volume was to the downside. Market participation was weakened meaningfully. After testing resistance the prior week, the accumulated New York Stock Exchange advanced decline line broke below the December 12th wide range bar, though it continues to hold its upward intermediate term trend. Leadership reflected similar behavior. The Qs failed to sustain progress after probing resistance near the upper end of its spitting top range, closing the week just above 212 support after briefly violating that earlier support level earlier in the week. The iShares Russell 2000 ETF mirrored this same action, retreating to test support near 245 and finished the week slightly below its midpoint around 250. Taking it all together, the final 2 weeks appeared less like an orchestrated retreat, but more like selective units being called back for year-end holiday leave. Participation has been thin, leadership has paused, and capital has grown cautious. But the true marching orders for 2026 are likely still forming behind the scenes and may not reveal themselves until liquidity and conviction return in the weeks ahead. Periods of transition often blur the lines between signal and noise. Price weakness has emerged. The absence of aggressive volume and the resilience of defensive and equal-weighted exposure suggest that recalibration rather than new marching orders. Investors should remain disciplined, emphasizing risk controls, respecting key support levels, and avoiding over-interpretation during thin volume moves. Conviction in capital will be the ultimate litmus test, separating genuine trend shifts from deceptive smoke screens. Until that conviction returns, preparation and patience remain the most reliable strategy. And then there were none left without a management plan.